All right. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. Yo, yo, yo. Hey, my name is Wayne. I'm a currency trader just like you. Oh my gosh. Let's take a look at the markets. Stock market just opened. Ding, 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 ding. It was the Dukes. It was the Dukes. All right, cool. So what do you want to do? Forex, crypto? You want to do some commodities? You want to do some stock indices? Let me know what you want to do. We're looking at a little bit of risk off. We're looking at some geopolitics. Lots of interesting things going on in the world. It's a great time to be alive and a great time to be a trader. So I'll let you be the boss. I am a humble servant. Let me know how I can help. Type in the chat, what would you like me to cover today? And I will do that. Let's go. So, Coolio, let me know what you want to cover. I have lost my chat. Sorry, I can't actually see what you're typing in the chat. Where did my YouTube go? I think I got a chat here. Hang on. I don't have YouTube up. YouTube, YouTube, youtube.com/Forex.Today. And then I gotta click on live, and there you are. That's cool. I don't have YouTube up. YouTube, 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 YouTube. All right, commodities. Do you have a particular commodity? Okay, let's take a look at, we'll do the stock market here. And our line in the sand is the monthly central. And we hit that yesterday and immediately stopped. Okay. Cool. Makes sense. Boom, 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 boom. Really, we're just stuck between a rock and a hard place. But based on the month of February, what does this chart say? Okay, let me change colors here. Okay. If this line here is the top, then this is the projected bottom, which we've already done. So we've already done this. This whole month of February played out in the first week. So now you need to decide what you want to do in March. So maybe we can simplify this. Be a simple kind of trader. Okay, from this perspective, nothing's even really happened yet, huh? How does that make you feel? Nothing has happened yet? No, not really. So now you need to decide, where are we going to be in, uh, let's say, in 6 months? Are we going to be here, or are we going to be here? That's all. Now, once you've made that decision, then it guides you through all your others. Now, is it likely that we're going to drop that much? I don't know. That's a long ways down. We would need, what would you say, 6 weeks of down, 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 down? That's a lot of down yet to come. Is it likely that we have that much down? Well, the Fed's staying higher for longer. Yeah, but that's not new, is it? So if we get some pricing out of people that were betting on lots of cuts, and suddenly they're like, there's not going to be lots of cuts. Okay, but does that drop us that much? No, I wouldn't think so. All right, how about WTI as a, yeah? Well, the TRADARS, we had this set up. Um, okay, we had that set up. Well, right, well before it occurred. Standard operating procedure, really, for um, technical analysis, but even fundamentally, uh, what you're seeing here is normal. Now, the catalyst for the move is geopolitics, but it's also not abnormal. They're just happening at the same time. Yeah, Richard's, yeah, the potential war between the United States and Iran. Yeah, yeah. But what if you had already had the opinion that oil was going to go up? How do you think about it? What if you already noticed the double bottom, higher high, higher low, higher high, higher low, and it's just technical analysis? And on top of that, you you had this opinion that somewhere around February and March, oil goes up. So what if you had 3 or 4 layers of opinion? Then it all comes together beyond the simple, oh, did you see the news? Fox and CNN says the United States is determined to go to war. You're like, really? Really? Well, then, boo-hoo for them for letting the secret out. Or maybe it's just fodder to sell you some more ads. Maybe you don't drive the right truck or buy the right dog food or use the right detergent. Well, they're there to help you with these decisions. Okay? But what if you just thought logically oil was likely to go up around this time? Well, that's a whole different kit and caboodle, isn't it? So I do have that opinion that somewhere at the middle to end of the first quarter. Okay. So it fits in there. And then the geopolitics kicks in. What else could we analyze to determine whether we're bullish or bearish? Well, this has been bullish since the third week of January. That's easy. But let's say beyond technical analysis. What kind of things could we look at to say we should be bullish on oil? Now, you hear in the media, oh, there's too much oil, the world is drowning in oil, all that kind of stuff. Some of it is mostly true, or most of it is somewhat true. Is there a source of your own truth beyond just listening to what you hear on TV? Huh? TRADARS. That's what we think. 90 days from now, we'll be at $88. Oh, oh, yes. Yeah, so we could look at inventories. We could look at rig count. We could look at global GDP for demand. So we have supply and we have demand. Yeah. Anyways, we were bearish on oil for at least 6 months straight, every day for 6 months. And then somewhere around the middle of January, we turned bullish. And it had nothing to do with the chart. But the chart at roughly the same time turned bullish too. And the fundamentals turned bullish. And the technicals turned bullish. And now, this is what I'm trying to tell you. And now we have a big green candle. And it's like, oh my God, the United States is going to war with Iran. Maybe. Probably not, but maybe. And now it's going up. Well, where have you been? Hey, Coach Maida. So, anyways, maybe it was happening anyways, and this falls in line with precisely the expectation. It's kind of neat to have facts, though, isn't it? Okay. Now, is the United States going to go to war with Iran? I don't know. No idea. Don't think so, but whatever. That's what's on the news now. Great. Fine. Good. Look at our falling rig counts. Anyways, neat, right? Cool beans, isn't it? Cool beans. Yeah. And so I like to rely on data, not news. There's a big difference between fundamentals and news, right? Yeah. So that's the 90-day projection, mathematically, by the way. Right? Mathematically. Cool. Now, is that going to be the real target? Well, I don't know. We update this, but um, it has to do with a lot of what is actually happening now, and this doesn't incorporate like projections of war. It uses seasonality, but not project. If war hits, then what? But it will update based on if we do go to war and there is a threat to supply, there will be an increase of price, most likely. I mean, it's logical that that happens, so it's probable that it would happen. And then this would update and project higher because it's also doing technical analysis. Cool, 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 cool beans. But this has been happening since the middle of January. So once again, today isn't the beginning of a big oil move. You're 6 weeks behind on. Yeah, we were at $50. Now we're basically on our way to $70, and then projected to continue at this rate at on our way to 90. But if anything, if we go to war, the velocity of the change, the rate of change will increase, and that will change things like our projected base case. But I would assume that comes with some volatility, so it changes our best case as well. So in, let's say, a week, if there is an attack by the United States on Iran, or Iran attacks us somehow, blowing up infrastructure in Louisiana or Texas, yeah, then all of a sudden, whoop, we have to change based on true analytics. So does this impact your analysis? Can we get to 73? It seems funny now, right? 73? You just pointed out 88. Uh, Let's take a different look at it then. You want to think big. You want to think real big. Sorry, I lost glasses. I'm wearing some other glasses. But anyways, what is this, 74? And we're so if we were talking about 88 and beyond, the the most bullish price to buy if you're a bull. And we knew this this was set in stone December 31st. Let me say that again. These calculations were set in stone December 31st. Okay? That is the best buying price of the year. Not that because it was, but that price, if you're long-term bull, is the price. Now, at that time, though, we thought this could possibly go down to 44. Well, that's the challenge of being a trader and an investor. Things change. So we had been falling for 6 months, and so TRADARS was showing a high probability of dropping as low as 44. But by the middle of January, Aiden, our artificial intelligence, updated his forecast. And suddenly, somewhere around here, bullet. So if you know how to trade pivot points, then this predicts that. That's 82. And Aiden's saying, well, if we continue at this rate, we should be able to hit it in the next 90 days. Do we know the future? No. Bears are going to think this. That might happen too. We don't know. Thing is, do you know what your opinion is? Are you a bull or a bear? That's the big thing. But if you are now a bull on oil, and there's lots of logical reasons, technically and fundamentally. It may not be correct, but there's lots of reasons to get to that decision. There's also lots of reasons maybe to not be so bull. Okay, fine. Pick a team. Cool. So can we get to 82? Yeah, in the next 90 days at this rate. And that's where the math comes in, right? When you're doing the math of it. At this rate. We don't know if it'll do it, but at this rate, we'll get there in 90 days. And it doesn't that shape your opinion of whether you're buying lower highs and lower lows? Yeah. So again, I'm pointing out you do fundamentals, your technicals become more clear, and this is yeah, yeah, just a lot of beautiful stuff going on here on this chart and behind the scenes. Cool. So what else would you like me to cover? Silver, gold, euro dollar. Talk to me, Goose. I am your humble servant. I am here to serve. Do, 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 do. Huh? I'm waiting. Are you trading exotics? We've run into some consolidation. So over here, I'd probably be thinking about reload if I were me. Okay. We're consolidating on Euro Rand, and you can see that the stop is being jammed hard. All right, so let's start with Aussie dollar, Kiwi dollar swing trades. Before I do something like that, I want you to tell me about what the street is talking about in terms of monetary policy by the RBA and by the Fed and by the RBNZ and the Fed. Also, beyond monetary policy and changes in monetary policy, what about geopolitics, like a potential war or at least a bombing or strike or something by Iran or the United States on each other? How would that? Because your point of view is going to impact the way you see the charts. This is why it's a bias. So the first part of that answer when it comes to monetary policy, Australia is going to raise interest rates soon, like at the next meeting. It's already in play, right? Yeah. Cool. Well, that could lead to carry trades. That could lead to Australian dollar strength. In particular, because unemployment in Australia is falling. Yeah, we know this because we have the data, don't we? Yeah. Of course we have data. What? Of course. What about geopolitics? How does that um impact the US dollar? Well, if it's purchased for a safe haven, first of all, people don't want the dollar, they want US treasuries so that they can get a yield. Yeah. But nonetheless, dollar strengthens, right? Okay. And it's a reserve currency, safe haven, all this kind of great. Well, then Aussie dollar could be conflicting. You see? Could be conflicting. So maybe Aussie dollar looks good. You might say upside. Upside it looks good. But you might want to look at Aussie yen or Aussie Swissy. Now, yen and Swissy, in my mind, are also reserve currency. They're also safe haven. Not actually, but in my mind and in Wayne's world. So if we are in a risk off scenario, we got to be careful because dollar, yen, and Swissy are likely to be strong or more likely to be strong. So you have to analyze market conditions. That's complicated, though, isn't it? That's why I start with something. Oh, hey, mate, I just saw your comment in the live. Yeah, I don't know if my post in the chat was bitchy. It certainly wasn't meant to be. Yeah, I got your screenshots from yesterday, but I spent hours and hours and hours and hours and hours and hours and hours yesterday rebuilding things. So, and did the hard coding. So, like, there should, so try to log out and log back in. I know it's one of those things that make people roll their eyes, but yeah, there were big changes made, and there's a high probability it'll work. Oh, but you said you already did it. Okay. The other thing it could be is multiple emails. So we should probably. All right. So let's look at. Someone asked about rand and peso and stuff. Okay. So back last year, we have to go through like how to trade, how to trade. As I went, as I went to, well, email me the email, email me the email that you're using for your coaching. Like I know, like Brian had a couple of different emails. I think I have three, and so I tried to filter, but I'll just if you have more than one, then I will just hard code all of them. So, but anyways, I think by Monday everything will be right as well. All right, going back to this, guys. Okay, guys. As I said earlier in the live stream, if this is your bottom, this is the projected top. That's the conservative. This is the most aggressive. We hit both precise. Okay? Look how precise this one is. It'd be foolish to expect more than that. That's what this means. It'd be foolish to expect more than that. But on the first day of the year, which was okay, first day of the year is here. Then it fell in January, and then in early February we bottomed out here. Yeah, yeah, yeah. And all of that is bullish. And if you're a bull, the most you could possibly expect would be this. Cool. Well, that happened. Cool. So that is dead. Then we had this massive collapse. Now, you have to know the first part. The first trade, euros are long, based on pivot point theory, is dead at this point. It's dead. Also, because this is a carry trade, it's impossible for me to buy this. So a move like this hits stops, exits, not in. So how do you get into a carry trade? You start to measure, hey, is this developing into a lower high? And remember, if you're a carry trader on Eurozar, you're thinking down. And you're thinking, I wonder how this annual pivot point here, annual R1, annual resistance number 1, defined 6 months in advance. What kind of role does it play? Is it going to act like resistance? Yeah, it looks like it. Okay, so we spend months there. Months. But it's summer. When is my favorite time of year to go risk on? Does anybody know? When's my favorite time of year to get serious about risk on? It's not July 1st. When's prime time risk on for the Wayne? Deploy capital. Get in the game. Tiger. Anybody know? Third week of September. Yeah. Anyway. No, that's no, not July 1st. Yeah. So, anyways, triple top over summer, then a lower low. Then a lower low. How do you trade a lower low after a quadruple top? By the way, Canada Day is risk off, take profit day, not risk on. Okay, so triple top, you can only be a bear. The bullish trade is dead. Now you can sell here, but that's crazy aggressive. Okay, so I'm not going to tell you, oh, dude, you should have sold up there. Whatever, save that for the YouTube gurus. What I'm telling you is at some point, okay, this up is dead, then months go by, and then months more go by, and then we get into prime time trading season, and then price makes a lower low after a triple top. So therefore, you want to then look for the lower high, probably the annual R1. And then on the third week of September, my true love gave to me a Euro Rand short. That took 1, 2, 3, 4, 5, 6, 7, 8, 9 months to set up. You don't have to be the fastest, you don't have to be the smartest, you just have to be prepared. Cool. So here we are. And it's now been 1 month, 2 months, 3 months, 4 months, 5 months. We're in the 6th month. That's how you do it. You know, does anyone have a question about these dots? The dot is there for a suggestion of the placement of my stop loss. How does it work? It's based on volatility, not on opinion, not on fear, not on pivot points, not on moving averages, not on something you see on TV. This black line is called PSAR, parabolic stop, right? And reverse. Now, this is very much misunderstood and taught wrong by gurus. So I like to simplify it and just call it, it's my parabolic stop. I'm not going to reverse my position. I'm going to unwind my. And so what it's looking at, the reason it's cool, if I were to zoom in, okay, you'll see that because I'm on a daily chart, it updates every day. If you really squint at it, you'll find that in the time that Eurozar is falling and falling quickly, okay, it doesn't move the stop, or it moves it very little. Let me repeat that. When Euro Rand is falling and falling fast, think of that as volatility, right? Volatility in my favor. It says, dude, don't get out of this trade. In fact, we're not even going to move the stop. Okay? Especially in the beginning, look at this. It took a month and a half just to get my stop at break even, according to parabolic stop analysis. A month and a half just to move my stop to break even. But every day I could be moving this. So right now, my stop could be here. It would be here. That's my stop. My entry is still here. That's my stop. So when this trade is really working well for me, it says, you know what? Don't do a thing. Don't do a thing. Leave it alone. It's working. But in periods of consolidation or even worse, pullbacks, it moves the stop faster. They're like, dude, this is slowing down, bro. Dude, this is slowing down. Lock in as much of the profit as possible. Or lock in the profit faster. Move your stop faster. Lock in faster. But then when it's working really well, leave it alone. And so I don't know how many pips this is. 750 pips. Now it's Euro Rand, so it's 20,000 or 120,000 pips. You're like, that doesn't make any sense. Well, Rand isn't worth very much. So it's a lot of Rand. So if you were to trade euro dollar, every pip is a dollar, right? So I have moved my stop to today's PSAR. I have $100 of capital that I risked because we're levered, right? Risked on this trade. And if it comes back and knocks me out, I'll only have $750 profit on the pips. Well, that's pretty good, don't you think? $750 on $100 of risk. So we're already at, at least 7 to 1 reward to risk. And look how far away my stop is. But don't forget, the whole point of the trade is short only, because I've also earned $160 in interest payments. So we'll call that $900, right? I get knocked out. At this stop, if it comes all the way up at this stop, I'm going to get knocked out for 750 pips, plus the 150 I've already collected in swap. So that's 900. So now 900% internal rate of return. That's one way to play a swing. Right now, I'm bearish. I'm good with this. Totally good with it. Totally fine. I'm going to keep letting it fall. Why? Well, what's my target? Well, the logical target is down there at 17. Well, we're at 19. Dude, I'm going to be short this a long time. Another 6 months. So Bill says 700% in 6 months, plus the interest. So it's 900. So if I can stay short another 6 months, then yeah, now we're at, 1,800%, depending on all that. And maybe it's, right? So maybe it's 2,000%. Cool. This is an actual trade. And we made it together as a group. This is a swing trade. And, I have to emphasize the money is made here. This is where the magic happens. And now every single day, I do nothing and I get paid. Because every day I collect interest. And in general, this is moving. Now I've moved my stop. So even if this whole thing collapses on geopolitics or something, okay, why not compound on this trade? You should be. Okay? You absolutely should be. Okay? This is my coaching account. The purpose of the coaching account is to spend, like this trade, we spent months preparing for, and probably the swing day trade we made, it could have been a 3-hour conversation. Okay? And so if you understand this, all these pullbacks, that's the easiest part of it. That's basic technical analysis. But if you don't know why you're doing it, or even that you should be doing it, well, that's the gap that I'm trying to fill. In fact, I think it all started because, every couple of years I'll do 1,000 pip trade, right? Because people, I don't know, it seems to be a trick for some people. Like, it's impressive. Why is it impressive? I do nothing every day. It's not impressive. It's just normal. It should be normal, right? So it's like every once in a while, it needs to be done. Fine, great. So we'll set it up. We'll spend weeks, and then I'll go boom, and I'm like, let me show you how to stay in a trade a long time. And we go through and all that kind of stuff, and then you move your stop to break even, and great. But after that, imagine you made the trade the way I explained it based on logic. You can only sell it because it's a carry trade. It's like a gajillion dollars if we keep adding to this trade. Of course, this is how hedge funds work. This is why I teach it over and over and over again. Let's say it differently. The way you trade as an amateur keeps you an amateur. Hedge funds don't trade like you, and you don't trade like hedge funds. So you're like, wait. So all I need to do, or one way to do, is to say, well, I want to have a theme. Now, in my trading, in the professional world, we call it a product. You sit down with a client, you're like, we are building a high yield portfolio, a high yield product. We're trading EM, emerging markets, an EM high yield. The reason I traded Euro Rand and not USD Rand is Euro had lower interest rates, significantly over, like half the interest rate that the United States did. This was a smarter trade by design, mathematically. Okay? And so you would design a portfolio. That is called a product. And then you sell a product to an investor. Hey, what kind of outcome do you want from my Forex trading? I have one that'll create a lot of income. But you're going to be exposed to emerging markets. How does that sound to you? And then they'll say, well, what about the risk? Oh, well, let me tell you how I'm going to handle it. And then you do. You explain all that kind of stuff. And that's how a professional thinks. I manage portfolios for endowments and charities. There's an investment thesis behind that, a mandate, and you have to tell people what you're going to do before you do it and why you're doing it, and then you have to go out and do it. Well, that's what I do for a living. Great. This is awesome. So how should you be trading? How should you be trading Forex? How should you be trading crypto, for example? While they trading crypto, trading currencies, trading stock indices, all have different levels of volatility, don't they? And have to have different tolerance. But that's why you need to analyze it. But ultimately, that you're proactive, not reactive. You know what you're going to do before you do it because you know why you want to do it, because many calculations have been done. So we'll go back. I can only sell it because I want to carry trade. I chose euro over dollar because I make more money. Because think of it this way, I have to borrow euro and then lend it to South Africa. Well, at the time, US dollar was 5%, euro was like 2.5%. So my borrowing cost 50% less, and all that would be my daily profit. So I'm like, well, this is smart. Okay. The up trade is dead, technically. I showed you that. Then the collapse, the retest, and the respect of annual resistance number 1, then the lower low, then the lower high, back retesting the R1 at my favorite time of the year to take a shot, to take on risk. Dude, that's not that complicated. It'll take a lot of patience, but I think you can learn that. And so then what's the next part of it? Well, as you mentioned, well, you add to it. Well, that's called professional trading. Conviction. When you hear conviction on TV when a professional is talking about it, they're talking about adding more money. Okay? They're talking about adding more money. So we go back and here's the entry. Okay, lower low. What's the next trade? Sell the lower high. Lower low. What's the next trade? Sell the next lower high. Okay. Did it make a lower low? No. Did it make a lower low? Yes. Lower low. What do? Sell the next lower high. Is this a lower low? No. Is this a lower low? Yes. Okay. Sell the lower high. Now notice the lower highs tend to happen around the moving averages. Oh my God, well, that's why I use them. I know I'm being facetious. But you're like, duh. Okay, cool. Lower low, lower high. Hey, look, that's silly moving average again. Yeah. Lower low. Okay, lower high at the moving averages. But now we haven't had a lower low in a long time. And we're testing these moving averages. Uh-oh, should I be concerned? Yeah. But if you notice, like if you really look, these are barely moving and these are moving a lot faster. So I'm jamming my stop because mathematically, based on parabolic analysis, that I'm losing momentum here. And so I'm increasing the momentum of jamming my stop. So when price slows down, I jam my stop fast. Lock in the profit, baby, because it's not working out as good. But over time, maybe it continues. And that's betting on the trend. All I know is maybe not now. Okay. The other thing you might notice is, we're kind of playing off the 55 right now, which is also slowing down. If you're using MACD is below the waterline, but rising. And I spent an hour, actually 2 hours talking about that this morning at TRADARS.com on how to enter your trades without subjectivity. Cool. So anyway, if it makes a lower low, lower high, cool, right on. But at a bare minimum, there's one trade, there's two trades, there's three, there's four, there's five, there's six, and there's seven. And the eighth would not be quite, it'd be too early right now for the number 8. So if the first one is, so where am I? 1,200 pips right now? So 1,200, let's just dumb it down, right? 1,100, we'll call it 900. We'll call this one 750. Okay, we'll call that 450. Call this, we'll call that 100. We'll call that 50. Okay, now that's a lot of pips. Of course it's a lot. That's what you're supposed to be doing. I don't know why you keep going after 15 or 20 pips a day. It doesn't make any sense. You know it doesn't make sense. Okay? Hedge funds don't do that. What are you talking about? They do this. Okay? Because on top of this, you're earning that yield. So now you're growing, you're getting paid every day on 8 trades, not the one trade. So that first trade 6 months ago has already paid me all the money back that I risked and then some. So 3 of these trades out of 7 are already been paid back, 100% risk free, because I risked, let's say, $100, and if I've been paid 100 to 150 for each one of those, I don't actually have any real risk anymore, because the stops are at break even, or in this case, better. So now you're like, dude, they're risk free, paid for, and money in the bank, cash money because you get paid real money every day, not theoretical like, ooh, if you took profit, then you would have a profit. No. You get paid cash every day, 7 days a week. Way better than trading bonds that pay you every, 1 month, 6 months, 12 months. You get paid every day in cash. Cool. So now here's where it gets kind of more interesting, because all of this should be fairly straightforward if you understand fundamentals and if you understand carry trading. Great. We have tools for that. This is what TRADARS is about. So if you don't understand that, you'll never do this. You just don't know. The second thing is then it's technicals. Well, the technical analysis should be straightforward. You shouldn't be struggling with technical analysis. That looks straightforward, doesn't it? Well, yeah. And it's a daily chart, so your entries don't have to be perfect. In fact, it took 9 months to set the stupid trade up. So now you don't have to be worried about, is your entry precision? Because if you're only going for 30 pips, but you're late on a trade, you've given up 50% of your profit. This takes that out of the equation. Dude, are you going to sell it at the moving averages or not? What's your problem? It's not that complicated is what I'm saying. Are you going to do it or not? That's the big question. And then you just do it based on sound technical analysis on smaller time frames, but you know what you're going to do before you do it. You're like, oh my God, we're right up there, the 2155 on the daily. So now when you're looking at a 15-minute chart or an hourly chart, even if you got a giant green candle for the day, you're like, ooh, this is getting nice. Can't wait to short this. But that's where amateurs go wrong. All they see is the big green candle, and they don't see that the big green candle is here. There was a giant green candle there. You see that? Let me remove it. You see? There was a giant green candle. Well, who the heck had the gall to sell that giant green candle? Well, somebody with great trade planning, opinion, which we call bias. They wanted the carry. They wanted the high price. They wanted to keep it below here because you can only sell lower highs. What I'm suggesting is after that, which we call a hanging man, okay, somewhere in here, you get short. You could be 3 or 4 days late and still get a decent price. And yet on a 15-minute chart, you're like, oh man, I was 2 minutes late. It cost me 50% of my profit. Okay, bro. Okay. You see where I'm getting here? So the real interesting part is, what do you do with your stops? And this is where professionals will disagree. How do you manage the risk? Because the trade shouldn't be the challenge. Yeah, that's right. Yeah, I enter trades on a 5-minute chart or a 15-minute chart. Yeah. But if you don't have this logic, this is strategy. And by the way, I wrote a book on this. I've been teaching this for 20 years. I'm doing a keynote speech on Monday in Las Vegas, in front of 2,000 people. It's a 2-hour speech on just like this. This is how you do it. I'm not making this up. This isn't newfound information. If you met me 20 years ago when I was young and beautiful, the same words would have been coming out of my mouth. And it's weird because I have about, 15 or 16 years of YouTube videos, and you can listen to me from 16 years ago, things that I recorded, and guess what? My charts are exactly the same, and I'm saying the same thing. So what do I mean here? Okay. The way we can handle this, let's say trader number 1 decides, okay, leave a stop at break even forever. Okay, there's the second entry. Here's the third entry. So stop has now been moved to break even. here's this entry stops at break even. This entry stops at break even. Okay. This entry that stops at break even, and this entry that. Okay. There we go. And we haven't entered the next one. Okay. Oh, got this one. Okay. Do you see the logic of this? No, it's a paid speech. It's paid. So I don't think they're releasing. I don't know. It's not my game. Yeah. Anyways, you could just leave the trades here forever. Or you stop at break even, and that's it. You never touch it. Now, this means you never intend to make any profit on pips. Okay. By the way, am I hitting the right topics here? Like, I follow you guys. You're my boss, so I didn't expect to be in this speech today. But is this good? Am I hitting the right targets? Is this striking a chord? There's only 5 thumbs up, so I'm not entirely sure. But imagine a world in which you made no pips, but you did you collected swap. You hedged everything else out, so you never make any pips, but you're making swap. There was a man named, or is a man who used Chuck Taylor, John Taylor ran the first Forex fund in the world as an institution. This goes back to the 70s. And it was called FX Concepts. Okay? And so he traded institutional money for people that needed to hedge risk. Cool. So he hedged risk. And so they started trading institutional money, big money. Cool. So at the end of the year, he made no pips by design. He ran his firm all the way to 2008 financial crisis. And he got hit by redemptions. Even though his Forex fund was still profitable, people were losing money everywhere else. And so they had to get their money out of the Forex fund to pay for their losses everywhere else. So it wasn't even his fault. But he ran from, let's say, 30 years he ran this Forex. And he never made any pips. He grew the company, and as the assets under management got bigger and bigger, he had to increase his staff. So he had hundreds of people working for him, mostly trying to figure out how to hedge out the risk. Cool. Because that's what clients were paying for. Great. So let's say in the first 10 years, he might have done okay. I don't know about that, but I know for at least this, at least 10 to 15 years, at least 10 to 15, maybe 20. He paid himself a salary. This is after making no pips. This is after paying for all the employees. This is after paying all the expense and paying for compliance and paying for lawyers and paying. You have 100 employees, dude, making what, 100 grand each on average? Maybe 150, because some people are making 3 or 300, 400,000. Remember, this is the 80s and 90s, right? And others are making 75, 80. But dude, all of a sudden you're like, well, their payroll is a lot, right? Yeah, yeah, it's expensive running a business. Cool. Making no pips. So let me jump to the conclusion. For at least 10 to 15 years, he paid himself a salary of $25 million a year. Huh. And he made no pips. He did this. So now there's no risk. I've hedged out the risk. How did I hedge out the risk? All my stops are in break even. But you could say, well, Wayne, these last two, you still have opportunity cost. You have capital locked up there. You could go back and get knocked out at break even, and you just wasted that capital. Like there is a loss. I'm like, well, not really, because I get all of the money back. There might be some opportunity cost, but I did get paid some in swap. Now, all of these, I've actually been paid the money back plus profit, not including the pips. So in this case, this is what he's been doing. I'm like 95% hedged out of risk. In fact, I have way more profit on these to pay for that. So really, in this case, in this example, this would be, at this point, risk-free. I've already gotten all my capital back. Plus, I still have, in this case, let's say they're standard lots. I still have $700,000 position, and I'm still collecting interest every day. So if I get knocked out, and let's say something happens, and it comes all the way back to where we were 6 months ago, guess what? I made a boatload of money. Then you say, whoa, but you left so many pips on the table. Well, that's the next way to do it. It's going to give you different results. It's a different strategy, but John Taylor from FX Concepts was in the business of reducing risk to zero, and the man lived like a king. Because you can live pretty good on $25 million a year, let me tell you. What's the other way of doing that? You right? One stop for all of them. Trying to show you like that there's lots of stops here. And when you enter the seventh trade and get the stop to break even, and you move the sixth stop to the same stop, the fifth one to the same stop, the fourth to the same stop, the third to the same stop. So now you're locking in all of that, so you get knocked out all at once. So you lock in the pips. The thing is, that is more and more likely to happen over time. And so now you're not compounding anymore. Where before you're like, oh, I can't lose money. I can only make money, and I'm making money cash. And the more trades I get in, the more I get paid every day. So you could just do that forever and never take profit. Never. This one is going to take you out at some point. Now the balance is the pips you make here could be worth a year of collecting swap, which is interest payments. So you're like, dude, I'm okay with that. But it might take you another year to get back into the trade. Meanwhile, the other person might lose 2 or 3 or 4 of these 7 trades as price comes back. Well, they didn't lose any money. But maybe 2, 3, and 4, 1, 2, 3, and 4 trades stay in there, and then the carry trade continues, euro rand continues to fall, and then you just add more ones back. But you could be short this forever, getting paid every day forever. Well, that's how John Taylor did. Here you get knocked out. You got 8, you got 1, 2, 3, 4. You got 6,000 pips plus 6 or 7 months worth of swap payments, and you're like, okay, I'm out at 10,000%, and now you got to go figure out something else to do. And now you go back to the productization process of, well, what do I want to do next? What's my next new thing? What's your new product? What's your new pitch? Because now think about every time you did that, you give the money back to your client, you keep 20% of it to yourself, so 2,000 pips for you. Great. And then you come up with the new shiny toy, you call up your clients, and you're like, hey, I want to do something else. I want to do oil to 100. I want to do a geopolitics play. I want to do something else. And you explain it, articulate it, and you point it out, and you manage the risk properly. And then they're like, yeah, let's do it. Now you got yourself another fund. Of course, you have to be licensed and registered, but it's a product. This is how professionals work. So because you'll notice trades work for a year or so, and then they fizzle out. And then you got to come up with a new trade. Well, market conditions change, geopolitics change, monetary policy changes. I mean, we used to do carry trades, let's say 20 years ago. That's all we did was basically carry trades. And then for about 7 or 8 years, we were at zero interest rate policy, ZIRP, at banks or central banks around the world. And there was no carry. There was no carry trade. And I said, mark my words, one day you will be a carry trader. And so this is how professionals work. Now they are doing this. So these are the decisions that you have to make. It's the risk management that is interesting. The actual trade should be just straightforward. Oh, you're on that Euro Rand trade? Oh, cool. Like we would both know why. Why are you there? Why are you short Euro Rand? Well, I want to pick up that huge swap. Why are you short Euro Rand? We also want to pick up that Euro swap. Oh, cool. How you manage your risk is different. So the third one is to just trail it. And I very much dislike when people just put like 100 pip trailing stop. Like, why? You can't make a decision? You don't have your big girl panties on? Hmm? Why can't you make a decision? In this case, I'm moving the stop based on volatility, not just some like, well, I'm willing to lose 100 pips because I can't make a decision. So I'll just trail it by 100 pips. And if it pops up 100 pips, then I get knocked out. I lose 100 pips. Wow, that doesn't sound smart. Okay? And I don't scale either. I don't take a little one here and a little one there. Okay? That's scaling's for fishermen, right? So there's 2 ways, leading and lagging. The lagging would be if I lose the volatility, the favorable volatility, meaning when this is falling fast and furious, I'm going to let it fall fast and furious. I want to get out of the way. Let it do its thing. I don't need to be involved. It's working, and it's working really well. It's when it's not working, I have to pay attention and then jam my stop and lock in the pips dynamically. That's what it's doing. Cool. Done. But it's not like some just 100 pips, I don't want to make a decision. Now, the third one is very much more technical. And that's where you're like, well, what's the projected low for the year? Okay. Well, based on my analysis, if we got down here in the middle of this year, 2026, I should probably take my profit based on my technical analysis. Just the same way that this, okay, the same way that this is obvious, simple, basic, elemental technical analysis. That is an out. Get up. Out. So I'm not stumbling around trying to figure that. So same thing, like if I'm here, notice this happened in the beginning of the second quarter. So we're still in the first quarter, but let's say we're down here, Canada Day. We were talking about Canada Day earlier, right? Let's say it's Canada Day, the most important day of the trading year. I would be forced to take profit. I would have to take all my pips and run. I'd have to get out of that beautiful carry trade, collecting all of that income. But the pips would be worth so much, it would be years of income that I can get paid right now. The sad thing, though, is I'd have to come up with a new thing. Okay, a new thing. Okay, and maybe it's this one. Okay, you'll notice that it's set up exactly the same way. The entry was slightly different, but basically the same. Okay. Okay. Roughly, right? Lower low, lower high, sell. Okay. Lower low, lower high, moving averages. Sell. Lower low, lower high, sell. No lower low. Yeah. So now I'm concerned. Why do I sometimes use yearly, and sometimes monthly, sometimes weekly, sometimes daily? Because they're different strategies. I want to be in a carry trade forever. So I'm thinking 6 months to 18 months in advance. So I showed you that I'm already targeting, what was it, 17 on Euro Rand. I did that analysis. So we're in February. I did that analysis back in November. I'm thinking months and in fact, an entire year in advance. Yeah. So that's that high level analytic. And when I go into swing trading to me lasts a few weeks. So that's why you want to say, well, what's the plan for the month? How does this week fit into that plan? And what about next month? So if I can get into this month, can it run into next month? And so that's why TRADARS will do things like tell you seasonality for this month and next month, and then try to predict when in the month, let's say, possible tops and bottoms have happened in the past, to give you an idea of like when in the month does the top and bottom hit. But here's the thing, if you don't know to even be watching for this information, then it's useless. But the thing is, it's almost impossible to be a professional trader and not know this. Because what happens is the amateur trader ends up just trading like an amateur. Yeah. And we all know it doesn't work out. There's no secret. So you have to make better trades by making better decisions, which means you need to have better information. So you're like, wait. So I just need to know that this is a carry trade, that I can only sell it so that I am lending US dollars to Mexico and they're willing to pay me money for it. You know? All I have to do is wait for things like consolidations, breakouts, pullbacks, right? And I'm like, yeah, yeah. Sell a downtrend at resistance. You don't need to be a genius for that. Sell high at resistance in a down. Buy low at support. Now let's be even more specific. Buy higher lows in an uptrend. Sell lower high in a downtrend. That's all it is. I don't care if you use MACD. I don't care if you use RSI. I don't care if you use stochastics. I don't care if you use moving averages. I don't care what moving averages. I don't care if you use Fibonacci. I don't care if you use Elliott Wave. I don't care if you use pivot. If you don't understand the concept of this should fall and this is a lower high at resistance, then nothing's going to work. If you are stuck on a 15-minute chart and a 5-minute chart, then you are stuck on noise and everything looks good, everything looks bad, and you're late for all of it. So, like, let's put this into context, and then I'll let you go. I've taken too much of your time. Yeah. You were waiting for a lower low, so you got a lower low. So now what are you waiting for? Lower high. Where? Well, probably somewhere around here, and probably somewhere around the moving average. Is that fair? I think it's fair. Great. So we're at the lower low. You're waiting. 1, 2, 3, 4, 5, 6, 7, 8, 10. 10 trading days. From the lower low to the lower high. Most amateurs don't even conceive of what's happening over a 2-week trading period. They're on a 15-minute. And they have no idea when suddenly the green candles turn red. Have no idea. And yet then there are professional traders that they're waiting to sell lower highs, and they're just not agreeing precisely what price, but they know they're going to sell, and they know the general price, and they take different shots. But amateurs, what do? It's been green for 4 days, so they buy it, and then it turns red. Then it's been green for 4 more days, and they buy it, and it turns red. And they have no idea what the heck's going on. And yet, the professional world is just like, dude, sell it, walk away. You know, like the institutional investors, like these guys sold it and walked away. And then the next week, more sold, and then they walked away. And you'd probably see this in the Commitment of Traders report. Do you even look it up? Okay. And amateurs just get slaughtered in the consolidation. Slaughtered. This is where you lose money, buddy. Right in there. You're buying and selling, and you're non-directional. This is where you get slaughtered. Buy and sell, buy and sell, buy and sell, buy and sell. Nothing seems to work. Okay. So stop doing it. Like, for crying out loud. Yeah. So you can track the COT. Let's pull it up. Let me show you how to do it. Okay. All right. So we go to financial, long format, Canadian dollar, Swiss franc, British pound, Japanese yen, Australian dollar, Mexican peso. Here it is. Okay. See specifically Mexican peso. Cool. So now, and by the way, I've been doing this for 20 years. Been doing this for 20 years. Now you can look at this and say, when do institutional investors start buying? This comes out once a week. You don't have to be fast if you're trading in the direction of institutions, right? Or trading with institutions. Okay. So now you just pull it up, and when do hedge funds and leverage funds go long? Okay. Well, less long there on asset managers. Less long for hedge funds. Oh, they're less long this week than last week. Oh, but I want to buy Mexican peso. Cool. So is that a signal to buy? No, they're selling their positions. They're changing their long positions. They're less long. So I can wait and wait and wait, assuming once again that I've already done all my analysis, and I say, well, I want to sell USD Mexican peso so I can earn that huge swap. Sweet. But now you're not doing it blindly. Now you can wait, and all of a sudden, let's say next week, this is a huge, huge plus number. Oh my God, institutions went long. Yeah, well, this is why it takes days, even weeks, for these things to change direction. So how do we read now? Okay, hedge funds dumped their long Mexican peso trade. Okay, so how do you say that? Hedge funds, okay, have been going this way. And in here, they took a lot of profit. That's it. Cool. They're still net long. Okay. And asset managers are heavily. Okay. What does this mean? They're long-term short, but there's been profit taking. You think it's because of things like the double bottom? Okay. So how did we handle this zone? How did we handle this zone? You can see these zones can last a long time. Are we in a new zone? Yeah. So how do you handle it? Lower low, lower high? It's just basic. But if you don't know that you're trading along with and like professional institutional investors, then how do you have the confidence to get out of bed and risk your money? That's the part that does make sense to me. I want you to trade like a professional. I'm not talking down to you. I'm building you up. TRADARS builds you up. Now you have absolutely no excuse to make amateur trade and amateur decision making, or no decision making at all. You have no excuse now. Now, in the past, you could say, well, I don't have economists, and I don't have quants, and I don't have AI, and I don't have all the fundamental data, and I can't afford all these subscriptions to all these government agencies. I'm just a simple person trading Forex out of my kitchen, out of my mom's basement. I'm just a scalper. You don't have any excuse. Yeah. So you either choose to step up or you're choosing to fall apart. Your choice. Yeah. So thank you for your time and attention. I'm sorry I went so long, but like I said, you're the boss. Just trying to serve. So cool. I will see you. Check out traders.com. It's free. You can get some upgrades. Free is awesome. Premium, but the free is awesome, let me tell you. So now you have no excuse. Well, Wayne, I want to trade like a professional and I want to trade like you, but I don't have any money. Well, it's free, dude. Now what's your excuse? I don't want to do the work. Yeah, well, good luck. Have fun with that life of quiet desperation. Yeah. Everyone else, I hope you want to be a boss because right? You have a boss in you. You are a boss. Peace on earth. May the pips be with you. May your profits be above average. Thank you for being here every day, and thank you for the loyalty and respect you show me every day. And patience.